Hello and welcome to our online classes. In this video, I'm going to try and explain to you the concept of flow of capital. In our previous videos, we talked about capital markets and the classification of capital markets into primary markets and secondary markets. In this video, we'll try and understand how does capital exactly flow in capital markets. Well, uh, I'm also going to try and explain to you why the flow of capital is very crucial in a market economy. Well, in any market economy, there is always a set of people who have excess capital. For example, anybody who works and is a professional, goes to office and works, always has a certain amount of savings in his bank, right? Well, that is actually excess capital which this person does not need immediately and he is saving for future consumption. At the same time, there is also a set of people or institutions who are in need of capital and would be able to do productive work or industrious work with the capital. Okay, so there needs to be a system where capital flows from those who have excess capital to those who need capital immediately. Capital markets provide this system. You can see on your screen, investors are on the left side. These are the people who have excess capital. Corporates, businesses, and governments, these are institutions who, from time to time, need capital. Okay? Now, this flow of capital from investors to corporates is done via capital markets. Of course, the investors are not going to provide the capital to these institutions free of cost. They, of course, expect a return. And that's where financial instruments play their role. Corporates, businesses, and governments create financial instruments which promise a certain return, and investors buy those financial instruments and provide the capital to the corporates, businesses, and the governments. Okay? This entire process via which the capital is flowing from the investor to the corporates is done via the primary market. Banks and financial institutions play the role of intermediaries. They are the middlemen in this transaction. The kind of financial securities that are traded, as I had explained in my first video, are either debt or equity or a combination of the two. Some complex financial securities which are a combination of both debt and equity. Now, once the investor has bought these financial securities from these guys, there needs to be a market where these investors will be able to trade these financial securities amongst themselves. Okay? And that's where a secondary market comes into the picture. It's a market where investors come together to trade amongst themselves the financial securities that they have bought from institutions who have raised capital via those financial securities. Okay? Now, the thing that I want to ask you now is, what do you think is the role of banks in a market economy? Well, banks play the role, as you can see in your screen, is they are facilitators of flow of capital from investors and depositors to governments and businesses. Banks take deposits from depositors, they pay those depositors a certain interest, and they make loans to the governments and businesses and earn a certain interest on that loan. The difference between the loan interest and the deposit interest is what the banks keep for itself. That's how the banks make profits, or they make money. Now, investment banks do the similar thing, but there is one crucial difference. The difference is that the banks directly take that capital and they lend out that capital to governments and businesses. Investment banks, on the other hand, simply connect investors to governments and businesses and take a fee out of the capital that is raised by governments and businesses. They directly do not take in the capital from the investors, which the traditional banks do. Investment banks simply help governments and businesses create financial securities, and they help them connect these governments and businesses to investors who get this capital. Okay? Yes. Now, the last thing that I want to talk about is, why do you think this flow of capitals is so important in a market economy? Well, this flow of capital is very important in a market economy because it is this capital which is what is the engine of growth, of economic productivity, of economic activity. Well, what do I mean by that? Well, I mean that corporates and businesses and governments, all of them need capital to be able to do something productive, right? So a capital market becomes very crucial because it is this market which helps these corporates and businesses get the capital, which in other case would be lying idle. These investors who have excess capital would have nothing to do with this capital had there not been a capital market where they could provide this capital to people who need the capital and in return earn a certain interest. That is why a capital market is so crucial in a market economy. I hope this concept of capital market is clear now. We're going to move forward now and try and understand in future videos what exactly stock markets are. We're going to talk about stock markets as the prime example of secondary markets. And then we're going to talk about one of the ways in which corporates and businesses raise capital in the primary market via something called an IPO. Till then, goodbye.